One of the most difficult yet essential aspects of market structure analysis is identifying a valid pullback. Mastering this skill allows traders to pinpoint genuine order blocks and inducement zones, which helps in avoiding common market traps. In today's advanced session, we'll be exploring different types of pullbacks, their related price actions, and practical trading strategies. More importantly, we'll uncover the key criteria and rules that transform an ordinary pullback into a high-probability trading opportunity. If this sounds useful to you, make sure to show your support by liking the video, subscribing to the channel, and turning on the notification bell to stay updated with our latest videos. Now, let's get started. The foundation of market structure analysis starts with correctly identifying valid pullbacks. Without this, it's difficult to anticipate major market moves like trend continuations, valid breakouts, or reversals. So, what exactly is a pullback? In simple terms, a pullback is a short-term reversal or pause in price movement against the current trend. This happens when both buyers and sellers compete for control, which leads to a sharp move that generates internal liquidity characterized as imbalances or static liquidity waiting to be swept or filled. As a result, the market temporarily pulls back to fill this liquidity before continuing in its original direction. Price movement can be broken down into three key phases: impulsive move, corrective move, and continuation. For instance, if we view this corrective move as a valid pullback, it typically comes with a confirmed break of structure. In such cases, an order block can usually be identified at the bottom of that movement, linked to the break of structure. Traders would then wait for the price to return to this order block and reverse upward. With this expectation, a buy limit order can be placed at the top of the identified order block. However, if the identified pullback happens to be incorrectly interpreted, or if the pullback isn't actually valid, then the associated order block also becomes unreliable, increasing the chances of the trade hitting stop loss. That's why it's essential to understand how to properly identify a valid pullback, along with the rules and conditions that define it. Later in the video, we will discuss various types of pullbacks, price behaviors, and related trading strategies to provide deeper insights. So, make sure to watch till the end so you don't miss out on any part. Before diving into examples of valid pullbacks using candlesticks, it's important to understand candlestick patterns in trends. In a candlestick-based uptrend, you typically see a series of bullish candles, each one closing higher than the last, signaling strong upward momentum. For a single bullish impulse to be valid, each candle's lowest point should match or be higher than the previous candle's low. This reflects limited bearish pressure and a market that is maintaining a solid upward trend. The same principles apply when analyzing a bearish trend. In a candlestick-based downtrend, the pattern consists of consecutive bearish candles, where each new candle closes below the previous one. This reflects strong downward pressure. For a bearish impulse to be valid, the high of each candle must remain at or below the high of the previous one. Now, to recognize a valid pullback during a bullish trend, one key sign is when a candle breaks below the previous candle or sweeps its liquidity. For example, in this illustration, you can see that the last red candle broke below a prior green candle. This signals a valid pullback. However, if the price doesn't break the previous low, the pullback cannot be considered a valid one. It's also important to remember that the color of the candle doesn't matter in determining whether a pullback is valid or not. It's the price action that matters. In the same way, during a bearish trend, a valid pullback is identified when a candle breaks above the previous candle, effectively sweeping liquidity. To strengthen our grasp of how pullbacks work, let's look at a few more examples. Imagine a sequence of bullish candles, followed by a brief pause, where three bearish candles appear before the uptrend continues. In a bullish setup, for a pullback to be valid, the price must break below the low of the last bullish candle before the bearish pause. In this case, none of the bearish candles managed to break that low or sweep its liquidity. Therefore, this entire candle pattern is viewed as a single bullish impulse rather than a valid pullback. In a similar situation shown in the second set of candles, after a series of bullish candles, there's a brief pause marked by a single bearish candle. Since this bearish candle doesn't break the low of any prior candles, it doesn't count as a valid pullback. However, if that bearish candle creates a high equal to the last bullish candle, and the next candle breaks and dips below its low, it would then be considered a valid pullback. This setup shows a bullish impulse, followed by a corrective move, and then a continuation of the bullish trend. These principles also apply to bearish market conditions and can be used on any time frame and across any price action chart. Here we're analyzing the Bitcoin chart on the 1-hour time frame. As we can see here, the market is in a strong downtrend. Now let's examine potential pullbacks on the chart. Here we have a sequence of 3 bearish candles, followed by a brief pause, which occurs with 3 bullish candles. When we mark the high of the last bearish candle before the pause, we can clearly see that price broke above it during the correction. So this counts as a valid pullback. Moving on, we still have a continued push to the downside, followed by another brief pause, marked by a single green candle. But if we mark the high of the last bearish candle before the pause, you can clearly see that the correction candle wasn't able to break above it. Same thing with this one right here. So these 2 pauses don't meet the criteria for a valid pullback and should instead be seen as part of a continued impulse move. Moving on, we have another valid pullback here, as price broke above the last bearish candle before the correction. So following the same pattern over and over, you can be able to identify valid pullbacks. Now that we've covered the foundational ideas around pullbacks in the first part of this video, we can confidently identify valid pullbacks in the market. In this second section, we'll explore more advanced concepts, including different types of pullbacks that traders often encounter and the trading strategies associated with them. Pullbacks generally fall into 3 main categories: aggressive pullbacks, corrective pullbacks, and sweeping pullbacks. Let's break down each type and examine how they can strengthen your trading approach. The first type is the aggressive pullback. This form of pullback is defined by a quick and sharp retracement against the main trend. It usually involves 1 or more large candles that swiftly retrace part of the recent price movement. For example, suppose we have a series of candles where the price breaks below the lowest point of the candle just before a temporary pause. This movement marks a valid pullback. Following the retracement, the price moves sharply upward with clear imbalance, confirming a valid break of structure. Since this move results in a bullish break of structure, we can now identify a demand zone associated with it. This zone is likely to act as a strong support area with a high potential to trigger a reversal when price gets back to it. Next, we wait for price to pull back into the identified demand zone. In the case of an aggressive pullback, this retracement typically happens quickly and forcefully, with strong candles driving the move straight into the supply or demand area. In such situations, even if lower timeframes show potential entry signals, it's not advisable to open a position. The reason is simple. When price approaches a key zone with strong momentum and no signs of weakness, there's a high chance it will ignore or break through that zone rather than reacting to it. Therefore, traders should be cautious and carefully observe how price behaves in these scenarios, avoiding impulsive entries just because a zone is being tapped. Now let's move on to the second type of pullback, the corrective pullback. A corrective pullback is characterized by a slower, more measured retracement. In the example provided, we observe a valid pullback where the lowest point of a candle was broken, leading to a confirmed break of structure and also a valid order block. Now, during a corrective pullback, price typically pulls back through a series of smaller candles, creating internal structures as it approaches the point of interest. During this phase, market momentum and volatility tend to slow down. Unlike aggressive pullbacks, corrective ones allow for more strategic trade entries. As the price approaches the demand or supply zone, traders can employ smart money concepts using either aggressive or conservative entry techniques. For instance, one may place a buy limit order at the top of the identified order block and wait for the market to trigger it, or choose a more cautious approach by allowing the price to enter the zone and then looking for confirmation on a lower time frame before entering. Now let's move on to the third type of pullback, the sweeping model. In this scenario, price forms liquidity pools near our zone, often in the form of equal highs and lows, or trendline liquidity. These areas serve as traps where pending orders and stop losses accumulate, waiting to be swept. Identifying a liquidity sweep just before price reaches a key zone is essential. This sweep signals the potential strength of that supply or demand area. We use these sweeps as a form of confirmation, because for the market to gain momentum, it needs liquidity. If price does not sweep liquidity before reaching a zone, it often treats that zone itself as the liquidity. For example, in the illustration, the price pulls back and forms equal lows, creating a liquidity pool below a double bottom. This setup suggests that many stop losses or pending buy orders lie just beneath it, close to our previously identified demand zone. By focusing on setups where liquidity sweeps occur before price reaches our zone, we align our trades with the natural mechanics of the market and reduce the chances of being caught in fake outs or trap moves. The presence of such a liquidity pool just beneath our demand zone acts as a strong signal for a potential reversal. Once we have this added confluence, the next step is to patiently wait for the price to sweep that liquidity and tap into our zone. After this happens, we can confidently look for long entries, such as placing a buy limit order directly at our demand zone or scaling down to lower time frames to look for more confirmations. So, that's all for this video, guys. If you found value in it, consider giving it a like, also subscribe and turn on the notification bell to stay updated on our latest strategies and insights.